Hello, my Centurions. This is General Romulus. I do apologize. The recording from yesterday's TNL, and that would be Thursday, May 14th. For some reason, TechSmith had a crash. Recording didn't happen. Now I want to do a quick update on the critical parts that was missed if you didn't attend it live. We went through our normal live routine covering the S&P 500, all the major indexes, foreign, the metals, currencies, Bitcoin, the 11 sectors, groups, individual stocks. However, there were a couple of issues that we look into every once in a while, not every week, but every once in a while, that allow us to get a good handle on the bigger picture, on the broader scope of what the general market is really doing. In other words, what's going on under the hood of a situation. If a doctor sees a patient, looks at their face, they may look healthy, but when they start doing diagnostic internal investigations, whether it's x-rays, MRIs, or other blood tests, they find that there's a sickness going on. Or perhaps it's the other way. They look terrible on the outside, but they're very healthy on the inside. So we want to see the inside of the market. What's really going on? What is the internal condition of the market itself? And there are a couple of important key indicators and determinant factors that we look at to help us understand this. Price is critically important. It's the most important. There's no indicator in the world that can be effective if price permanently ignores it, okay? We can have all the analytical and theoretical discussions that we want, but if price doesn't care, then it doesn't matter. So price just pulled back today. This is Friday, May 15th. Just pulling back today from its all-time high of yesterday. That's not a 52-week high. That is an all-time high of 75.17. So on price alone, things look fine, right? Now, the internal condition of the market, one of the aspects that we will not cover today is volume. We go over this quite a bit. Remember, back in the middle of January, right here, we started noticing January 13th and on, before the correction kicked in from the Iran-US war, that volume was acting very suspicious. It was bearishly divergent from price action. Price action was consolidating, chopping around from the late October highs. Not a big deal, but the volume was telling us a different story. So that told us to keep our yellow flag raised. That told us to stay out of the fake outs to the upside. That told us to stay away from the hype. That also enabled us to not get involved in the 10% correction that was started by the US-Iran war. Okay, so that's one of those situations that we're talking about right here. Now the market's up at a new all-time high. What is going on underneath the hood? So one thing we like to look at, and you should write these down, there are not that many, is the advanced decline line. Remember, the number of stocks going up versus the number of stocks going down on a given day, and you can draw a line about that. Here is the S&P 500. Again, this is yesterday. You see it at a new all-time high. I cannot blow this up any bigger. Sorry about that. But you can see it's at a new all-time high. But look at the advanced decline line. This is pretty powerfully bearishly divergent from the price action itself. Price has gone up, and up, and the advanced decline line has been going lower and lower and lower. Perhaps that's one reason why we saw a pretty sharp correction today. That cannot sustain itself. This is creating a situation where the ice is getting thin. The rally is on price, looks good, but it's a thin rally. The market itself is going up. Remember, the S&P 500 is a capitalization weighted index. We will explain more about that in some other educational opportunities, not tonight. But that means that it can be held up and pushed up by just a handful of stocks. And that's living proof right here. And by a handful of stocks, as of yesterday, there were really only two, Apple and NVIDIA. That's it. Now, I lived and worked through and traded through the dot-com mania and the dot-com crash. One hallmark of the dot-com mania, as it was going higher, was that it was going higher, up and up in price, but the advanced decline lines for the indexes were declining. So the ice was getting thinner. The rally was being supported by fewer and fewer stocks. However, in all my days, I've never seen a rally so thin before as to be supported only by a handful of big chip and tech companies. That's it. I mean, Apple and NVIDIA aren't the only ones, but this was the thinnest rally to a new all-time high on the S&P that I have ever experienced And I've been doing this for over 30 years. Okay. So we have the advanced decline line, bearishly divergent with the S&P 500. Okay, the next is a number of stocks hitting new 52-week highs and lows. So here we have the New York Stock Exchange, which is more like the S&P 500 than the NASDAQ, but we'll look at both. So you think just yesterday with the S&P 500 at a new all-time high, that the number of stocks hitting new 52-week highs should also be very high. It doesn't have to be at an all-time record high, but it should be very high. However, it's so far below its early February peak that it's kind of ridiculous, actually. Kind of ridiculous. And look, even today, it just hit a low that it hasn't seen since March. And the S&P only fell for one day, not even 1.5%. That's not adding up. Okay, that's the New York Stock Exchange. Let's go to the NASDAQ, where you're probably thinking, well, we're going to see a much different result, Romulus, because the NASDAQ is where all the action's been. Nope. Uh-oh. I mean, even back here, you couldn't surpass what you saw back here in January. Okay, bearishly divergent. This is the kind of stuff that I saw before the 2022 bear market. This is the kind of stuff I saw before the 08 bear market. Right here, this is the kind of stuff that was presenting itself. I don't think we're going into a bear market, by the way. Let me be clear about that. However, we need to pay attention to this stuff. And forget about that this looks like a head and shoulder. Indicators upon indicators are sketchy at best. That's probably just a coincidence. But anyway, so again, why isn't this much higher? This should be way higher than this level back here that we saw in late January. Way higher. With the NASDAQ pumping and pumping the new highs for weeks on end, it should be way higher than that. It's not. Oh, let's look at the number of stocks hitting new 52-week lows. We shouldn't see many of those, right? Nah, not so fast. Plenty of them. Okay, plenty of them. And here's the NASDAQ. This is yesterday, but here it is. So it's not adding up. We have a bearish divergence now in the advanced decline line. We have a bearish divergence showing up in the number of stocks hitting new 52-week highs and lows. And we're going to continue as we go, okay? Next thing we like to look at is the RSI itself, down at the bottom. And it is right here on a daily basis at 77, 78. That is not all-time highs, but close to it. There's no bearish divergence going on, but it's just at a very, very high level. Here's the NASDAQ. Not long ago, it was at 84, 83, 84. Here are the chip stocks. Take a look at these. That's up here in the 80s as well. When you see levels like this, it's only a matter of time before a correction sets in. It doesn't have to be a nasty correction like what we saw in March for the war, but 3 to 5% easy, and we've already seen the 1.5, okay? All right, so we have that happening. Now, last is percentage of stocks trading around above or below their own moving averages. The yellow line is the 50, the red line is the 200-day moving average. And with the S&P hitting new all-time highs, with the NASDAQ hitting new all-time highs, with the Russell 2000 hitting new all-time highs, with the Dow Jones just off of a new all-time high, you would say, and I can't blame you for saying this, that, oh, General Romulus, we've got stocks, they're all above all the moving averages. All of them. They're cranking. They are all cranking. Yeah, no, not happening. Okay? Take a look. Only half the stocks, and this morning, as of today, though, it got even lower. Only half the stocks in the S&P 500 are trading above their own 200-day moving average. That's nuts. That is absolutely nuts. What about Russell 2000? A little over half. Well, NASDAQ for sure, right? We're good there. I mean, again, that's where all the action is. 57% on the NASDAQ 100 and 58% in the NASDAQ. This should be way up. This should be in the 70s, maybe even the 80s for all of them. Okay? And this is like that for all the moving averages. Here's the 50-day moving average at 43%. Here's the 20-day moving average at 35%. And here's the 5-day moving average. Okay? And this is like that for all the indexes. So we have bearish divergences on all of the major indicators except for price action itself. And price action is the most important one. So until this starts to give it up, and we would start to look at trend lines. And since this was so sharp, I mean, I don't know. I mean, I could see a quick return down here to 71.85, give or take, somewhat easily, because it started to go up on some vapor. I mean, really, again, this whole rally was just, that's it. It's one stock. It's NVIDIA. That's really it. So, okay, this has been General Romulus. Appreciate your time tonight, or whenever you happen to be watching this. Send in questions, thoughts, comments about these ideas. These are really, really important. Write them down. Pay attention to them. We do it every couple of weeks, but you should watch them once a week on your own now that you know how to do it. We will see you soon. Remember, consistent returns, regardless of market direction. Bye-bye.